Imagine waking up one morning and realizing the stock market has crashed. Headlines are screaming, people are panicking, everyone around you is talking about pulling out their money. But instead of fear, you feel calm, prepared, almost confident, because you know something most people don't. Recessions don't just destroy wealth, they transfer it. From the people who panic to the people who are prepared. Now let me ask you something. If a recession started tomorrow, would you be ready to take advantage of it? Or would you be like most people, frozen, confused, and terrified of making the wrong move? Stay with me, because today you and I are going to break down something that schools never bothered to teach you. How to profit during a recession, ethically, strategically, and intelligently. And by the end of this video, you'll understand why some of the richest people on the planet get excited when the market crashes. Before we start, tell me in the comments, have you ever invested during a recession before? Just type yes, no, or I'm learning. I want to know where you're starting from, and if you're new here, hit that subscribe button, because we make deep, practical, long-form videos that actually help you think differently, act smarter, and create your own financial advantage. Alright, let's begin. Let's slow down, take a breath, and look at something so obvious. Almost nobody sees it. Every recession in history has created two groups. Group A, people who panic, sell everything, lose money, and spend years trying to recover. Group B, people who stay calm, buy the right assets at the right time, and build massive long-term wealth. So what makes the difference? Is it luck? Is it intelligence? Is it timing? Not really. It's preparation, mindset, and understanding how recessions work. Think about names like Warren Buffett, Charlie Munger, Ray Dalio. These people didn't get rich by avoiding downturns. They got rich because they understood recessions better than anyone else. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." But here's the truth that nobody usually adds. You can't be greedy when others are fearful unless you already understand what you're doing. So today, let's build that understanding, step by step. What actually happens in a recession? To profit during a recession, you must first understand what causes it. Let me show you a simple mental image. Something perfect for a whiteboard animation. Imagine the economy as a long line moving upward over time. But instead of moving smoothly, it moves in waves. Boom, bust, growth, contraction, repeat. This cycle has repeated for over 100 years, and guess what? It's not stopping. In a recession, businesses slow down, people spend less, unemployment rises, fear increases, stocks fall, real estate drops, confidence disappears. But here's the part almost nobody sees. Prices fall faster than actual value. That means during recessions, many strong companies become temporarily undervalued, not because they're bad businesses, but because people are scared. Let me give you a real example. During the 2008 recession, Amazon fell by more than 60%. Apple dropped around 50%. Netflix dropped nearly 40%. Imagine that. Amazon, Apple, Netflix. Companies everyone trusts today. If you invested just $1,000 in Amazon during the crash, a few years later, it would have turned into more than $10,000. Why? Because the company didn't become worthless. People just panicked. This is the core idea behind profiting from recessions, buying valuable assets when they're temporarily cheap. But let's go deeper. Why most people never profit from a recession? If profiting during a crash is so obvious in hindsight, why don't most people do it? It comes down to three things. 1. Fear. Fear is powerful. When people hear crash, their brain screams, "Get out, protect yourself," and they end up selling at the worst possible time. 2. No cash ready. Most people are so pressured by bills and debt that they don't have spare cash to invest when opportunities appear. 3. Lack of knowledge. You can't invest in what you don't understand, and when you don't understand something, you fear it. So you and I are going to solve all three problems today. We're going to build your knowledge, your confidence, and your strategy. Ready? Let's move forward. The mindset of investors who win during a recession. Before we talk about what to buy, we need to talk about how to think. Here are the three traits of recession winners. 1. They think long-term. Short-term thinkers panic. Long-term thinkers prepare. Every major market crash in history looked catastrophic in the moment, but every single one eventually recovered. Look at the charts of the Great Depression, the 1987 crash, the dot-com crash, the 2008 recession, the 2020 crash. Every single time, the market recovered and then went even higher. 2. They don't try to time the bottom. Smart investors don't try to buy at the perfect moment. Why? Because nobody knows where the bottom truly is. Instead, they use simple strategies like dollar cost averaging, buying in stages, investing gradually as prices fall. This removes emotion, it creates discipline, and it keeps you invested even when the news is negative. 3. They only buy what they understand. This is huge. Recessions expose weak businesses, so you must understand how the company makes money, whether it has strong cash flow, whether it has strong leadership, whether it has long-term demand, whether it's financially stable. Simple rule: if you don't understand a company, don't buy it, even if the price falls. All right, now you've got the mindset. Now let's get into the strategies, the practical tools you can actually use, how to profit during a recession, step by step. Time to break down exactly how to profit during an economic downturn. Think of this as your recession opportunity framework. Step 1. Build your opportunity fund. You cannot take advantage of a recession if you have no money ready, so start building an opportunity fund. This isn't your emergency fund. This isn't your savings. This is money specifically set aside for investments during downturns. It can be $20 a week, $50 a month, any amount you can consistently set aside. When the market drops, your opportunity fund becomes your greatest superpower. Step 2. Focus on recession-resistant companies. Not all companies survive recessions equally. Some industries remain stable because people still need them during tough times. Examples include healthcare, utilities, consumer staples, food, cleaning products, basic essentials, discount stores, repair services, insurance. These companies don't collapse during downturns. They often remain steady. Investors often call them safe harbors. Step 3. Look for strong companies on sale. This is where real wealth is built. During recessions, great companies temporarily go on sale. Look for companies that have long track records, strong cash reserves, loyal customers, growing demand, low debt, good management. Think of companies like Apple, Microsoft, Google, Amazon, Costco, Coca-Cola, Johnson & Johnson. These aren't penny stocks. They're stable, proven companies with long-term value. During a recession, they drop in price, but their long-term potential remains strong. That's your opportunity. Step 4. Use dollar cost averaging. Let's say a stock normally costs $200. During a recession, it drops to $150, then $130, then $110, then $100. If you put all your money in at $150, you might feel unlucky as it keeps falling. But if you invest gradually, buying a little each month, your overall cost becomes lower, without stress, without guessing. This is how long-term investors win. Step 5. Diversify your investments. Don't put everything into one company or one industry. Spread your investments across stocks, index funds, bonds, real estate, REITs, cash reserves, digital assets, carefully. Diversification is your shield. It reduces risk, it calms your emotions, and it helps your portfolio survive downturns. Step 6. Keep investing even when it feels scary. This is the hardest part emotionally. Every piece of news will scream, the economy is doomed. This time is different. Everything will collapse. But historically, those headlines always appear right before things get better. Warren Buffett invested billions in 2008 when everyone was scared, and that's why he profited billions when the market recovered. You must remember, fear creates opportunity, confidence creates profit, discipline creates wealth. Step 7. Invest in yourself. This is the part most people forget. Recessions are not just about investing in the stock market, they are the best time to learn new skills, increase your income, build a side business, improve your career, expand your knowledge. Because when people panic, you get ahead by becoming more valuable. Let me give you a real example. During the 2020 lockdown, millions of people stayed home doing nothing. but thousands learned new digital skills: video editing, copywriting, programming, marketing, online business. Those people came out stronger, more skilled, and earning more. This is also a form of recession investing. You invest in yourself, and the returns last forever. Real-life stories of people who profited during a crash. Let's slow down and walk through real examples, because stories make concepts real. Story 1. The investor who bought Apple during the 2008 crisis. There was a man named David. In 2008, the market fell by nearly 50%. People were terrified. Friends told him to sell everything. News channels predicted disaster. But David believed in Apple's future: strong product lineup, loyal customers, great leadership. He ignored the fear and invested consistently, buying small amounts each month. Fast forward years later. His investment grew more than 10 times, not because he was lucky, but because he understood two things. Fear makes prices fall. Value stays the same. Story 2. The woman who bought real estate during a downturn. There was a woman named Karen. During the recession, property prices dropped fast. Everybody said, "Don't buy now. Prices will crash. Wait for things to get better." But Karen had a stable job and savings. She found a good property selling for far less than its normal value. She bought it, rented it out, held it for years. When the market recovered, the value nearly doubled. Rents increased, her income grew, her wealth increased quietly. Again, not luck, just preparation. Story 3. The man who learned new skills during a recession. A man named Joseph lost his job during a recession. Instead of feeling defeated, he used the time to learn graphic design, digital marketing, freelance skills. He built an online portfolio, got clients, and ended up making more than at his old job. All because he invested in himself when others froze. These stories show something powerful. Recessions don't choose winners. Actions choose winners. What not to do during a recession. Now let's talk about the mistakes that destroy wealth. Avoid these at all costs. 1. Don't panic sell. When you panic sell, you turn temporary losses into permanent losses. It's like jumping off a boat during a storm. The storm was temporary, but the jump is final. 2. Don't put all your money into one investment. No matter how confident you are, do not go all in. Diversification protects your future. 3. Don't buy just because prices are low. Low price doesn't mean good value. A bad company at a low price is still a bad company. 4. Don't borrow money to invest. Using debt during a recession is dangerous. You don't want pressure. You don't want stress. You want clarity. 5. Don't listen to panic news. News channels exaggerate fear because fear gets views. If you let them control your emotions, you will make poor decisions. Let's put everything together into a simple roadmap you can follow. Step 1. Build an opportunity fund. Even small amounts matter. Step 2. Identify recession-resistant industries. Healthcare, utilities, consumer staples. Step 3. Identify strong companies to buy on sale. Apple, Microsoft, Costco, and others. Step 4. Dollar cost average. Invest slowly and steadily. Step 5. Diversify. Spread your investments. Step 6. Keep emotions low. Stick to the plan. Step 7. Invest in yourself. Skills, knowledge, income. When you follow this roadmap, you turn recessions from something frightening into something empowering. You shift from reacting to opportunities to preparing for them. You shift from fear to confidence. Let's slow down for a moment. Think about the future. Think about the next recession, because there will be one. Nobody can predict when, but it will come. Now imagine this. Next time the market falls, while everyone else is panicking, while headlines scream fear, while people rush to sell, you, on the other hand, feel calm, prepared, focused, because you know exactly what to do. You know how to protect yourself, how to stay stable, how to buy strong assets when they're cheap, how to grow your future while everyone else is running from theirs. That's the power of understanding, that's the power of preparation, and that's the power of investing during a recession. If this video helped you, let me know in the comments. What part of this guide was most useful for you? And if you want more long, deep, practical videos like this, Hit that subscribe button right now. It helps the channel, it motivates me, and it ensures you never miss a strategy that could help your financial future. Thanks for watching. Stay smart, stay prepared, and remember, recessions don't destroy wealth, they simply transfer it to people who know what to do. See you in the next video.